Welcome to the deep dive. Today, we're venturing into the world of algorithmic trading performance. It's definitely a topic catching a lot of eyes for folks looking to maybe use automated systems in their investing,
It absolutely is. And yeah, it can seem pretty complex right off the bat.
right? Like a maze, trying to figure out if these automated systems are actually working, delivering the goods, so to speak.
There's certainly a lot of jargon, a lot of data points flying around.
Exactly. So our mission today really is to cut through some of that. We want to unpack the essential metrics, the benchmarks you can actually use to judge how well these trading algorithms are doing.
Kind of like a toolkit for evaluation.
Yeah, exactly. Your guide to seeing what really counts when you're looking at these systems. We're leaning on some really good material that breaks down the nuts and bolts of performance here.
Sounds good.
Okay, so where do we even start? What are the absolute, must-know things we should be paying attention to first?
Well, I think a logical place to begin is with the core performance indicators. You know, the basics. Okay.
Two really fundamental ones here are the win rate and the risk-reward
The
ratio.
win rate. Okay, I think I get that one.
Yeah, it's pretty simple. It's just the percentage of trades that end up being profitable.
Right.
So naturally, you'd think a higher win rate means the algorithm's good at spotting winners.
Makes sense. So if it makes 100 trades, 70 are winners. That's a 70% win rate. Sounds great, right? But our sources seem to say that's not the whole story.
Not at all.
Yeah.
Yeah, a high win rate feels good, but it doesn't automatically mean you're making money overall. And that's where the risk-reward ratio comes in. It's absolutely crucial.
Okay, explain that one. Risk reward.
So this ratio compares the average profit you make on your winning trades versus the average loss you take on your losing trades.
Okay.
So let's say, for example, you tend to make $150 when you win, but maybe you only lose $50 when you lose.
Right.
That gives you a risk-reward ratio of 3 to 1. $3 gained for every $1 risked on average. Okay. So even if you don't win, like every time, if your wins are much bigger than your losses,
Exactly. Those bigger wins can more than make up for the smaller losses.
that's where it gets interesting, isn't it? Because it sounds like a system that maybe wins less often, say only 50% of the time,
Mm-hmm.
could actually be more profitable in the long run if it has a really good risk-reward ratio, like that 3 to 1, or even better.
Precisely. You've hit the nail on the head. Think about it. A strategy that racks up tons of tiny wins might feel good moment to moment.
Yeah, it feels like you're always winning.
Right. But then maybe a couple of really big losses come along and just wipe all those little gains out.
Ouch.
Yeah. So a favorable risk-reward ratio, it gives you that buffer. It allows for overall profit even if the win rate isn't stellar, which, leads us naturally into thinking about how to manage those losses when they do happen.
Okay, so just counting wins isn't the answer.
That's
Got it. We need to understand the risk side, too. What metrics help us there? Let's talk risk management.
Right. Two really important ones for understanding risk are the maximum drawdown and the Sharpe ratio.
Maximum drawdown. Sounds serious.
Well, it tells you something serious. It's the largest drop your account sees from its highest point, its peak, down to its lowest point, the trough, during a specific time. It basically shows you the potential worst-case scenario loss you might have had to sit through.
Okay, so if my investment climbs up to $20,000,
Mm-hmm.
and then it drops down to $15,000 before it starts climbing again, that $5,000 drop,
Yeah.
or 25%, that's the maximum drawdown for that period.
Exactly. That's it.
Wow. Okay, that really paints a picture of the volatility, doesn't it?
Mm.
And maybe the kind of stomach you need for those swings.
It really does. It's a critical measure of that potential downside risk. You need to know if you can handle that kind of dip.
Makes sense. And the other one? Sharpe ratio.
Right, the Sharpe ratio. Now, what's interesting here is it looks at both things together, the return you're getting and the risk you took to get it. Think of it as measuring how much extra return you're getting for the volatility, for the risk you're taking on.
So like return per unit of risk.
Essentially, yes. A higher Sharpe ratio generally means you're getting better returns for the amount of risk involved. Better compensation for the bumps in the road, you could say.
Risk-adjusted return.
Yeah.
Okay. So it's not just about the raw profit number, but whether that profit was worth the roller coaster ride to get it.
You got it. A higher Sharpe ratio usually points to a more attractive performance, considering the risk. Okay, so now we've kind of got a handle on measuring wins, measuring losses, measuring risk.
Mm-hmm.
Let's dig into the bottom line. Is the algorithm actually making money overall?
Yeah, the million-dollar question, right?
Right.
Or hopefully more. What are the key profitability benchmarks then?
Well, one really key one is the profit factor.
Profit factor.
It's calculated by taking the total gross profit from all your winning trades
Yeah.
and dividing it by the total gross loss from all your losing trades over whatever period you're looking at.
Right, so total wins divided by total losses.
Gross amounts, yeah. And if that number is greater than 1.0, it means the system is profitable.
Makes sense. If it's less than 1, you're losing money.
Exactly. And the higher that profit factor is, the more profit the system is generating compared to its losses.
So a profit factor of, I don't know, 2.5 would mean it's making $2.50 for every dollar it loses?
Precisely. That indicates pretty strong performance. And then, of course, we should also look at the more direct measures people are probably familiar with.
Like ROI?
Yeah, return on investment, ROI, and also annualized returns.
Right.
ROI just tells you the percentage gain on your initial investment over time. Annualized returns basically take that ROI and figure out what it would be over a full year.
So that helps compare things, even if one system ran for 6 months and another for 18.
Exactly. It standardizes it to an annual figure. These metrics just directly show you how well your money is actually growing or not growing.
Okay, these all feel like really crucial pieces. Now, something else our sources brought up was this idea of high watermark metrics in the context of, like, transparency and making sure interests are aligned. How does that work?
Ah, yes, the high watermark. It's a specific way of charging fees, often seen in managed accounts, using these algorithms.
Okay.
Basically, with this structure, the service provider, the manager, only gets paid a performance fee on new profits. That means profits that take the account value above its previous highest point.
Oh, I see. So if the account value goes up, hits a peak, then dips down.
Mm-hmm.
The manager doesn't earn any more performance fees until the account not only recovers that dip, but goes past the old peak.
Exactly right. They only get paid on the net new gains above the highest point the account has ever reached before.
Wow. Okay. That really does sound like it puts their interests right alongside the investors. They don't make money unless the investor makes new money.
It absolutely does. It creates a very strong incentive for them to generate consistent, positive returns because their compensation is directly tied to growing your capital past previous highs.
That makes a lot of sense.
And if we're talking about these kinds of managed account services, the source material specifically mentions Fata Ventures Ltd. As an example here. Another really important aspect is how well the trades are actually executed.
Right, yeah. Because you can have the smartest algorithm in the world, but if the trades don't get placed properly in the live market...
It won't perform as expected, exactly. So what metrics matter there?
Good question. What should we look for?
The key things are trade execution speed and slippage rates.
Speed and slippage, okay.
Execution speed is just how fast the system can get an order placed and filled once it spots an opportunity. Pretty self-explanatory.
And slippage.
Slippage is when the price your trade actually gets filled at is different from the price you expected when the order was sent.
Ah, okay. And I can imagine, especially in markets that are moving really fast,
Mm-hmm.
even a tiny delay or a bit of slippage could mean getting a much worse price, right? Turning a good trade into a mediocre one or worse.
Absolutely. That's one of the big advantages claimed by automated systems. They're designed to react almost instantly.
To minimize that delay and slippage.
Precisely. They process data incredibly fast and send orders electronically, aiming to get you the best possible price close to what the algorithm intended. So for those managed account services where someone else is running the system for you, checking on these execution metrics is really important for judging their operational efficiency.
Okay, wow. So we've covered quite a bit here. Win rates, risk reward, maximum drawdown, Sharpe ratio, profit factor, ROI, that high watermark idea, and now execution efficiency, speed and slippage.
Yeah, it's a lot of pieces.
It really drives home the point that you absolutely cannot just look at one of these numbers by itself, can you?
No way. Evaluating these systems really demands a comprehensive look. You've got to see how all these interconnected metrics play together.
Right. Focusing only on a super high win rate could be totally misleading if the few losses are huge, wiping everything out.
Yeah.
Or if the risk taken was massive.
Exactly. And these benchmarks aren't just for looking back for grading past performance. They're also vital tools for actually refining the algorithms going forward.
Adapting to market changes.
Right. Markets are always shifting.
Yeah.
So continuous monitoring, tweaking the system based on what these metrics are telling you, that's crucial for aiming for better results down the road.
That makes sense. And look, we have to stress this. Just like our sources do, this whole discussion is purely for educational purposes.
Absolutely.
It was also explicitly noted in the material that Fata Ventures Ltd., which was mentioned as an example, is not a regulated entity.
Very important point.
So for anyone thinking about their services or, frankly, any algorithmic trading system, you absolutely have to do your own homework. Deep, independent research.
Mm-hmm.
And definitely talk to a qualified financial advisor before making any decisions. That's just essential.
Couldn't agree more. Due diligence is non-negotiable in investing.
The sources did also share some social media links for Fade Adventures Ltd. Um, let's see, youtube.com @FadeAdventures, and facebook.com for the Fade Adventures if you want to look further. But again, keep that disclaimer and the need for research front and center.
Right.
They also listed a bunch of relevant hashtags, things like hashtag managed accounts, hashtag automated trading, hashtag risk management. Could be useful for finding more info online if you're digging deeper.
Resources to be aware of, used cautiously.
So, okay, wrapping this up. Big takeaway seems clear. Really getting a grip on how well an algorithmic trading system works isn't about finding one magic number.
Definitely not.
It's about taking this holistic view, looking at a whole range of factors that are all linked together. How often it wins, sure, but also how much it wins versus loses, how much risk it takes, is it actually profitable overall, and how smoothly does it even place the trades.
That sums it up perfectly. By understanding these key indicators, you can hopefully move beyond just the marketing hype and make much more informed choices about whether this kind of trading fits or how it might fit into your own investment plans.
This has been really insightful, definitely demystified a lot of this. So here's a final thought for you, the listener, to chew on. Considering all these metrics we've talked about, which specific aspects of algorithmic trading performance should maybe get your closest attention based on your own personal investment goals and, just as importantly, your own comfort level with risk? Something to really think about as you navigate your financial journey. Thanks for joining us on The Deep Dive.